Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We try on this show and on this channel to really help people have a more successful retirement, especially financially. We focus on asset management, the retirement planning, tax planning. Regardless of whether you're 20 and looking forward to retirement or already in retirement, a lot of the things we cover can help you, either get prepared to have a really good retirement or continue to try to improve the retirement that you're already in. And we do this particular show to just be able to answer questions. There's not a lot of educational materials out there on what to do, especially in these three main areas in retirement. So you can send in these questions now at the email address you see here on the screen, asktom@talkmoneywithtom.com. And you can send those anytime, actually, during the week. And we also cover what happens during some of our client strategy sessions. You can also put the questions into the chat here if you'd like to on the channel. Whatever you want to do here, we're very happy to answer. So start sending those questions now. We already have some good ones that we're going to be covering today also, so I'm looking forward to that. The other thing that we really believe in here, and the reason we've established this channel, is that I think education, the more you know about retirement, the better that you can do. And so we have almost 1,000 videos now on the channel, so you can go look at those. You can subscribe to the channel. You can hit the little bell if you want to know when we put something new on there. And then, of course, you can always meet with Ethan and I if you'd like, just for kind of a custom time frame, 30 minutes, phone, video appointment with us. You can ask us some specific questions that have more to do with your situation, possibly, as far as that goes. So really looking forward to today, to being able to try to help you, get farther down the road in this particular area. So I want to thank you for joining us for that. So I do always like to start off every show with a summary of what I saw happening in the market. Well, we didn't have a show last week, so I'm going to cover the last 2 weeks. This particular chart that you're looking at here is the S&P 500 as of 2 weeks ago. This is the one I showed from the last show. And here's what we're looking at, and I think it's very important to kind of understand. We call a primary trend the major trend of the market, be up or down or sideways. And then you've got this secondary trend where you kind of have the market go the other direction of the primary trend. So if you look at that red line there, the primary trend so far for this year is obviously down. But we had this unbelievable run-up going on that started in the middle of June and peaked out there in early August. And what we kind of have like a checklist of things we'd like to see so that smaller trend, that would be the secondary trend at the moment, becomes the primary trend, and we reestablish an upward trend as the primary trend. So we'd like to see the market breaking through different resistance points. So in other words, where the market has spent a lot of time and a lot of people accumulated shares, and they tend to kind of want to sell when it gets back there. Eventually that gets dried up, and we see strength that goes through. And we did that. We actually broke through 3 fairly major resistance points all the way up until this point. The next thing we like to see is really the market retrace at least half of the loss that we had. And so that happened. So we did it. We broke through the 50% retracement level. And then next, in this particular case, we like to see it break through the 200-day moving average, which is that blue line that you see there. And so it got really close. It got within 1 point of breaking through the 200-day moving average, and it fell. And so it's a couple weeks ago, it was still hanging out there. And then ultimately, if it would have broken through, we would like to have seen it, break through the trend line, that red line there, and then eventually continue to have enough strength to drag the 200-day moving average into the upward direction instead of the downward direction. Unfortunately, over this last 2 weeks, here's what happened, right? So that little piece of hanging up there eventually kind of fell down. And then if you look, there's one big red bar there. That's last Friday. And that is where the Federal Reserve does their Jackson Hole meeting every year. And Chairman Powell came out, had an 8-minute speech, did not allow any questions. And the Federal Reserve is very, very interested in trying to see the stock market come down. They have said exactly that, which is kind of amazing. And what happened was, during this run-up, some of the questions and some of the things that were asked of the Federal Reserve were interpreted as, hey, we're looking at the data, and the interpretation there was, if they're looking at the data is getting better, and we might be seeing a situation where they start to reduce rates. Matter of fact, the market was expecting less rate increases than the Fed said they might do, and expecting a rate decrease sooner than the Fed said they would do. And so the market's responding to that. Because again, market's looking forward 6 to 18 months. If rates are going to come down and inflation's going to get under control, then the market can start to take off. And the Fed doesn't like this because they're trying to fight a very high inflationary scenario right now where if people have a lot of money in growth in their homes, growth in their stock portfolios, their 401ks, their IRAs, whatever it is, they feel more wealthy. And so they start to spend more. And the Federal Reserve wants to help make us feel like we shouldn't be spending because it is one of the problems. People are spending. Matter of fact, we saw a nearly record amount of credit card debt accumulated in July by households here in the U.S. And so what's happening is there's this huge pent-up demand. People want to get out there. They want to do things. They want to go out to eat. They want to travel. And even if they don't have the money, they're going to borrow the money. We had this very large amount of savings that was there from the pandemic and all the money that was handed out. It seems like a lot of that has dried up and things are more expensive now. So, of course, some people are compensating for that by borrowing. So, and the Fed wants all of this to stop so that they can get inflation back from 9.1% at the high back down to 2%. And so that big red bar just continued all the way through this week. We had basically lower lows all week up until yesterday. Yesterday we had a low that we hit and then we reversed, actually a pretty nice reversal, and ended up for the day. A very nice run right at the end of the day. But today's been really fascinating. Today's an important day because today's the day that they report the job picture for last month, for August. And so the market opened up. The numbers were pretty good. So we had 315,000 jobs created. The expectation was for 298,000. So that's okay. We don't want like 500 and some odd thousand jobs, unfortunately, in this environment like we had last month. And we don't want, 100,000 jobs. Meeting expectations is a really good thing here. And the market was up 1.5%, depending on what index you're looking at this morning. And then, of course, we had the scenario where unemployment actually went up. It went from 3.5% to 3.7%, which normally is a bad thing. But again, the Federal Reserve is looking for softer job market. We have too many job openings. We have a situation where there's not enough people coming out to work, and that causes the possibility of higher wages, and you get this big cycle that can really drive inflation. Wages did not grow as much as expected in August. Again, normally a bad thing, but in this particular case is a good thing. And we had a higher participation rate. So the total number of people, I think it was 367,000 new people entered the workforce. And so that's really needed because the problem is we're at 62.4% of the U.S. population is currently working. And they need that to come up as much as possible to kind of alleviate the pressure that's on the job market. And so today's report was actually very good. And most of the data that we're seeing is quite good. Gas prices have been coming down almost every day for almost 3 months now. You've got a scenario where the headline inflation, whether it's CPI or PCE, is coming down. Core inflation on all the different measures have been coming down. Still very high, right? So that's part of the problem. But the trend is on the downward slope. But the Federal Reserve doesn't want your accounts to be worth a lot. And they don't want to see these breakthroughs. They don't want to see this market take off because it's counterproductive for them to try to bring down inflation. Again, if we feel wealthy, we're going to possibly spend or borrow or do whatever we have. And so this is part of the program. They're raising rates, they're trying to reduce liquidity, they're reducing their balance sheet, and they're talking as aggressive as they possibly can. And this week, one of the big catalysts was one of the Fed presidents talking about how she felt that the market is still off, that it would be over 4% that the Fed fund rate gets to by next year, which is more than the market thinks, and that we wouldn't have any rate decreases in 2023, which of course the market felt like there might be a possibility of rate decreases early in 2023. So that created another downturn and such too. So I will say one thing in my opinion, what they're talking about, we call it job owning. They're trying to talk the market down. You can see it's working, right? But it doesn't always work long term because the data eventually kind of plays out. The one fear that we all have is that the Federal Reserve doesn't interpret the data properly. This has happened before, and over raises rates and slows things down too much, and the stock market suffers because of that, even if possibly it didn't need to. So this is a good time to be cautious until we see what happens with the Federal Reserve. We get more data coming in that's continuing to show improvements in some of these areas. There's lots of geopolitical things that can happen with Russia, obviously controlling a lot of energy for Europe. There's a situation in China. They're having some economic problems. They're actually reducing interest rates there to try to support the country. So some things to watch out for that are out there. But the big picture right now has really to do with what the Federal Reserve is saying and doing and what the data is showing. So the problem that we're having right now in this particular downturn, if we go back to kind of where we were, a couple of weeks ago, and we look at what's happened here in the last 2 weeks, we've broken through a lot of pieces that are important. We've retraced half of what we gained. That's not good. We broke through 2 of the resistance levels that we broke through on the way up. So we're still bouncing off of this last one, which is a good thing. Hopefully we hold. We do have a higher low here. Again, that could be good. So, we'll have to wait and see what's happening right now. We are pulling some of the risk off the table, reducing some of our stock market exposure just as we watch this happening, just because, again, I look at it like we're standing on the edge of a cliff. We haven't fallen off that cliff, but we need to be careful, and we need to basically, get a parachute on. And that parachute for me is just reducing risk. And we take some of our stock market holdings and move them into T-bill ETFs, at least for the short term, just to wait and see what happens here, because we really don't want to be unprepared and fall off that cliff with no parachute. So I think it's a good time to be a little bit careful as far as that goes, and that's what we're advocating at this point in time. So anyway, that's my outlook for this last couple of weeks. It's an incredible time frame with all of the high inflation, lockdowns in China. We've got this whole scenario going on in Ukraine and Russia and all these other areas, these inputs that are happening, pent-up demand. It's a really, really incredible time frame. Very difficult to figure out what's going to happen. Stay diversified. Make sure you got your parachute is what I would say at this point in time. So anyway, looking forward to being able to talk to you again next week about what I see happening. All right, Ethan, what questions do we have today?
So, what are the income limits on a Roth IRA? So, an IRA is an individual retirement account, and so for a single person or I think head of household, it will be $129,000. And anything, if you're below that, you can make the contribution of $6,000, or if you're if you're older than 50, you can make an additional $1,000 contribution for $7,000. And for married, filing jointly, it's $204,000. And so there's also a phase, kind of like a phase out of these, like when you can do. So if you're between like 129 and 144,000, you can make a contribution to your Roth, but you can't make that maximum $6,000. And similarly for jointly, you have 204,000 and to 214,000, where you can make that kind of phased out contribution. And if you're above, you're unable to do the kind of standard annual contribution to a Roth.
Okay, so if you're above these limits, then the options of putting money into a Roth are not there, right?
You can do it, but it's not. You'd have to do it through conversions. You can't just do it like a regular deposit like you do with if you're under those limits.
They call that a backdoor Roth, essentially, right?
Yep.
Okay, so what I think one of the things that is interesting to me about the whole Roth contribution piece, and that's changed so many times over the years as to who can do it, what the limits are. It's crazy to try to keep up with that, but it's definitely worth looking at. You're going to have to decide whether you want to contribute to a regular IRA and get the write-off, or contribute to the Roth IRA where you don't get the write-off, but you do get tax-free growth. So those are always choices that you have as far as that goes, assuming that you qualify for the Roth the Roth contribution.
Yeah, and the thing is, you have till when you file your taxes, April 15th of the following year, to make this contribution. So if you ever feel that you're kind of close to that limit, I recommend waiting until you complete your taxes and then make that decision to do the contribution.
Yeah, because they basically have a penalty if you over contribute. So basically, if you contribute and your income is too high, you have to get it back out of there because they'll charge you a penalty for that. So we've had that happen to a couple clients where they just made more money than they thought they were going to make and had to withdraw back the money from the contribution. So okay, good. What's our next question?
When do I need to start taking required minimum distributions or RMDs?
Yeah, this is an interesting question. Lots of people have asked, it used to be 70 and a half, and so some people still think that's true. It did change to 72, right? So that's good to know. So technically, the way it works is that there's going to be a year where you turn 72, and you have up until April 1st of the following year, essentially the year you turn 73, to take out that distribution. There's a calculation. It's based on the value of the account that you're looking at in the prior year, right? So essentially, for me, if I'm 72, I would be looking at the end of the year when I was 71, right? And so that value, last trading day, there's a little formula you go in, you can figure out how much you have to withdraw. And I have until I'm April 1st of the year I'm actually 73. Go ahead.
But the one thing you have to be a caveat if you delay that is that you're going to have kind of that double RMD that you're required to take because you also in that following year have to take your RMD for 73.
Yeah, that's right. So once I turn 73, if I'm taking out my 72 distribution, because it's one time, you can delay it up till April only that one time, and so then when I'm actually 73, I still have to take out my 73-year-old debt distribution in that year, so I could end up with double amounts. The only time you'd ever want to do that is if you either forgot and messed up, and so you're scrambling to get it done, and you have a little bit of a leeway there till April 1st, or you actually have a big amount of income that's coming in your 72 years old year, and you want to delay more income until 73 just because it actually works out better tax-wise as far as that goes. So there's a little bit of flexibility there. I get a lot of questions that people think they have to do it by their birthday, and so that's something we can clear up here. You actually have to do it on the normal year. That first year you have until April 1st, but on a normal year you'll have until the last day of the year, right, to take that out. I will say, in our experience, these custodians are getting really hammered by these required minimum distribution situations at the end of the year. And boy, I wouldn't wait until the very end because some of them don't even have the labor to get it done. Maybe mid-November is a much better time to look at than December 31st.
Yep.
Just because you could end up with the scenario where they can't get the distribution done. There is some issues there as far as that goes.
And you don't want to pay that 50% penalty.
No, that's right. That's the penalty that really does drive this. And required minimum distributions are, you have to take them out. They're taxable. If you do a conversion of a Roth IRA, you have to take out the required minimum distribution first. You can gift through what's called the qualified charitable distribution, part or all of your required minimum distribution to charities. That would make it not end up on the tax return. So if you're already giving money to charities, and let's say I have to take out $10,000 and I'm already giving money to charities, I could give $5,000 to those charities, and then only $5,000 ends up on my tax return. Then you don't have to take them evenly out of every single account you have. As far as the IRAs goes, you can combine those together. 401ks have some special rules, though, correct? So
Yep.
basically, if you're still working at 72 or beyond, you don't have to take a required minimum distribution out of the 401k at that job. Other 401ks that you might have sitting out there don't have that special exemption, but for that situation, you can do that. We don't have a lot of those scenarios per se, but it's happened a few times.
Yeah, and there's also you can take RMDs if you have multiple IRAs. Let's say, for example, you could take an RMD for all those IRAs from only one of those. So, but that only works for individual retirement accounts and 403bs. If you become a 401k, each 401k you have to take an RMD for.
Yeah,
so
separately.
Yep.
Yeah, exactly. So, obviously maybe there's some, opportunity there to make sure that you've got all of your things where you want them, if you still want them in the 401k for some reason. If not, and it just happens to be sitting out there and you're just not really paying attention to it, maybe it's a good chance to kind of combine that in with your IRAs. There's pros and cons to that, but one of them is that you got a little bit more flexibility as far as how you handle your RMDs potentially, as far as that goes. But it is actually a really big area for tax planning within retirement, is understanding required minimum distributions. The more you have in these retirement plans, the more it can make an impact on what is going on for you tax-wise. And there's lots of different things you can do all the way through your life, to be honest, to try to reduce the impact of these requirement distributions. We've been ballyhooing this for so long because we really get to see, kind of the end result of this. And, so we're trying to get people to pay attention to this area because I think it's important. All right, do we have other questions?
So why did we have a positive job growth report, but unemployment went up?
Yeah, so think about that. So we had 315,000 jobs that were created in August, but the unemployment, the percentage of people that were unemployed actually went up from 3.5% to 3.7%. It's because there's 62.4% of the people in the U.S. are working, so there's this kind of slop in between those two, in essence. So I remember a situation where, for example, one category is laying people off and another category is hiring. So for a while there in 2021, the auto manufacturers were laying off because they couldn't make cars and trucks. They had to close down the factories, at least temporarily, because they couldn't get the semiconductor chips. So it'd be this big layoffs happening in the auto, yet people were coming back to restaurants and traveling, and big hiring going on in hotels and in different service industries. So that's what happens essentially, is that you've got this scenario where there can be some, new jobs here. The number of new jobs open is at 11.2 million. That grew from 11 million actually too. So that's really fascinating. Job openings are growing. That's not what the Federal Reserve wants to see. But you can get high layoffs in certain categories, right? Matter of fact, we've heard a lot of stuff happening in the tech business, just because there's some kind of overvaluations there. Tech oftentimes need that kind of run up in price of shares to really make things work, especially in the venture capital arena, if you want to get new money coming in. And so when the venture capitalists kind of pull back because tech shares aren't doing well, all of a sudden these companies, they don't actually have earnings. A lot of them. So the only way to really survive is to kind of cut back on some of the employees. So you can have higher layoff in tech, and restaurant workers getting hired left and right, because they're just desperate to try to fill the demand that's coming through travel, all of it. I mean, they're short on pilots, they're, all of it as far as that goes. So what you're seeing there is just a disparity between, one segment that's coming down and another segment that's coming up as things have been continued to roll and reopen as far as that goes. So that's a good question.
So what is the annual gift tax exclusion, and how is it different from the lifetime gift tax exception or exemption?
All right, so we do have a visual on this. So we got this earlier. So you can give $16,000 per year per person so for example, if my wife and I wanted to give my child and their spouse money, we could actually give away quite a bit, because I could give $16,000 to my child, $16,000 to that child's spouse, so that's $32,000. Yep. My wife could do the same thing, and that's $64,000. So technically, we can give that couple $64,000 without affecting our lifetime exemption. So right now, lifetime exemption is $12.06 million. It's not a round number just because it keeps going up with inflation, and a lot of people have a living trust, which actually allows them to potentially double that. Yep. And so then if I have a living trust, I could do $24 million. And what that exemption does is it just means that I can pass that money to my beneficiaries without estate taxes, right? If I give away more than $16,000 per person, let's say I've got a child who needs $100,000 to get something done, on their house. I can give them that 100,000.
Mm-hmm.
But I'm only allowed to give them 16,000.
Yep.
So the other 84,000 is going to reduce my gift tax exemption from 12.06 million down to 84,000.
Yeah. And one thing to be
Down by 84,000. Sorry.
yeah. And one thing to be aware of is that in 2026, with current laws, is the exemption will be going down to 6.03 million, which will be adjusted for inflation from now until then, but it'll go down. The IRS has basically said they will not claw back if you go above that. So if I say I gave my family $10 million, and then the exemption goes back to $6 million, the IRS says that's fine. What you did with these current laws is okay. We won't tax that, and we won't use it against you. But anything above that in the future, we will tax.
Yeah, so this is it's an interesting area because people get really twisted up on this in total. It depends on how much money you have as to whether it really matters that much, right? I mean, if you don't have a lot of money and you want to give 50 or 60,000 to somebody, then and it comes off of your lifetime exemption and you never expect to have that much anyway. I mean, even if it drops to 6 million and I have $1 million and I give away 50,000 instead of 16,000, so what is that, an extra $34,000, right? That comes off my exemption. Now I'm down to a little bit less than 6 million, but I have only $1 million. So, but you do have to be a little bit careful because two things can happen. Number one, you could have a windfall. You could have things really grow and you could live a lot longer than you think. The taxes are quite high above that to your estate, or they could change the rules and make it a lot less of an exemption. It used to be $1 million. So who knows what they might do going forward. The government is running a deficit, so there's always this possibility that they take a look at estates as a possible place to get revenue. And so you do want to probably stick as much as possible. So for example, if I was going to give away, 50,000, maybe I'd give 16,000 right this year, put the other 34,000 in a note, and then just continue to give 16,000 until I wipe out that note for that person. That would not affect my gift tax exclusion. So, exemption, the lifetime one, right?
Yeah,
So,
there's a lot of tax planning things or estate planning things you can do for estate tax. And if you have kind of like a custom question for your situation, it'd be great to, schedule a little call for it. And then we can go over that. And so it's especially true for couples because these are individual limits. So you can transfer unused stuff from unused exemptions from one spouse to another. And so you can get up to that 12 million even after it drops back down and still be okay.
yeah, exactly. But it's a good question. It comes up quite often. It's something that, we end up kind of covering on a regular basis as far as that goes because we've got, our clients are older and they're looking to, trying to help their kids and their grandkids in different areas. So it's a good thing to know about.
So should I take money out of my health savings account, or a lot of people refer to it as HSA, or should I just leave it and let it grow?
Yeah, this is actually quite interesting. And so I've got a visual here. We can talk about, what you can put in there. And so these are some of the limits that are happening from the last couple of years as to what you can contribute. So HSA, health savings account, is actually quite unique because whatever you have in there can grow tax-free. And now, and more, they're having HSAs that allow you to kind of pick different investments. Not all of them, but so you could theoretically have some stock market investment gains over a long period of time that grow completely tax-free. And then the other part that's very, very unique is that you actually get it as a write-off also. So if I put in $5,000, I don't have to put that on my tax return.
Yep.
So that's pretty unique. There's only, one other thing I can think about like that. A couple of the 529 state plans work that way. But the criteria then is, though, I have to take the money out to spend it on medical costs. And there's, different things that they call medical costs. But one of the strategies that should be thought about here is the possibility of accumulating money in the HSA, which almost nobody thinks about. Most people put it in and then they take it out to pay that year's medical costs. And they'll even say, hey, I think I might have $5,000 this year. I'm going to put in 5,000, and they take out 5,000 by the end of the year. And what they're doing, though, is they're missing out on tax-free growth.
Yep.
Now, some people don't have a choice. If you don't have excess money that you can save, then that's what you should do. If I don't have excess money, but if I put in 5,000 and I can pay my $5,000 cost with other monies outside the HSA, now I can let it grow. Maybe that turns into 6,000 or 7,000 or 8,000, and you could really make that grow until retirement. And then you get in retirement. Now you got this pool of money that is available to help you pay your medical costs, deductibles. I've even heard that you can pay your Medicare cost itself directly using your HSA. And you've got this retirement benefit that's growing tax-free. And I've seen people with over $100,000 in their HSA heading into retirement. It's very powerful. I mean, really, really neat.
Yeah, and this is one tidbit you can pass along to your children or your grandchildren is if you're a younger age, most likely your medical expenses will be lower. And that's when you kind of could utilize these HSAs. And then I recommend that you let them grow until your retirement. And even if you put a little bit of money, it can grow into a massive sum just by compounding interest.
Oh, it's incredible. So, I mean, obviously you always want to maximize your 401k match. So if you're at a company that has a 401k and they have a match, put enough money in there to get that match because that's 100% rate of return on that. So that's really, really powerful. But then maybe look at the HSA also. Not everybody has them, right? You have to have a program at work. And if you do have one, it's worth looking at in terms of another place to start to kind of get some money in. It can only be used for medical expenses, and if you happen to get into retirement and not need it, that could be a waste. But I haven't seen that happen, honestly, because medical expenses are pretty, like death and taxes. They're kind of nearly a certainty. Just deductibles on prescriptions and things along those lines are enough to kind of eat into a lot of areas.
Yeah, and so HSAs, you're only eligible if you're in a high deductible health plan. So you have to know which insurance you're actually picking for the year. So when you enroll, it usually says this is an HSA eligible insurance or something like that to let you know that you can do it.
I saw a report from Fidelity last year that said that the average person will spend $237,000 during their retirement on medical costs. And so think about that. If you had that, for example, in an HSA program, you could pay it all tax-free, because otherwise during retirement you're paying that $237,000 mostly without any write-off, because in order to get a write-off of medical costs, you have to spend so much per year, and that can happen, right, in long-term care, and I do have some clients that are getting write-offs, but wouldn't it be nice to have a big chunk of money in an HSA program to kind of offset that for somebody's retirement? Because now it's growing tax-free, I can take it out tax-free for those expenses. So really, really powerful concept. I don't think it's enough, information out there about as far as that goes.
So could you explain tax-free growth and kind of just explain the power of it?
Yeah, so tax-free growth, I mean, there's tax-free income that we've always had, going back as far as I can remember, and that's for municipal bonds specifically. So you buy that bond from municipality, the interest is tax-free. Tax-free growth means that there's some appreciation. So if I buy something at $10 and it grows to $12, a stock or even a bond, right? Some of them can go up in value. Then that $2 per share or whatever it is, growth, it can potentially be tax-free if it's in the right vehicles, okay? And that's super powerful, because think about that. So if I made 20%, like at just $10 to $12, I made 20% growth. If that's in a taxable account when I sell it, I'm going to have to pay taxes on it. Hopefully, if I've held it for more than a year, I'm going to have to pay long-term capital gains tax, might be 15 or 20%, plus I'm going to pay state taxes on that depending on what state I live in. Now, if it's tax-free growth, I get to keep all 20%. That's super powerful. So the differential between what you would pay in tax is gone. And so it just allows a lot more spending power. So imagine an IRA that has $1 million in it versus a Roth IRA that has $1 million in it. They're not even remotely the same. If you take the taxes out of that IRA as you distribute it over time, it might only be worth I don't know, 700, 750,000, kind of depending on how you take it out and when and what's going on, versus the Roth IRA is worth $1 million, period. Take it out, there's no tax. And so tax-free growth is the ability to have something grow without any tax cost on it. It's very, very unique. And actually, it's fairly new. I mean, the Roth IRAs, there's the HSAs, the health savings accounts that grow tax-free, has a limit in terms of what you can put in it and a limit on how you take it out. You have to spend it on medical costs, right? But if you do that, tax-free growth. So you can buy different investments inside your HSA and have that grow. Then there's the 529 plan, which is, again, for college costs, even private school costs now, some of the things that happen. Again, you put money in. Some states you actually get a write-off for that, which is kind of interesting. Most you don't. You don't here in California. But it does grow tax-free. So if I bought $10 in a 529 plan, it grew to 20, and we took it out for college costs, I don't have any taxes on that extra, money that I made. And then, of course, a Roth IRA is the big one. Yeah.
Yep.
And that, again, has some limits as to what you can put in it, unlimited as to what you can convert from your existing retirement plans to put in there. But you better be careful and know how you're doing that. Talk to us about that, because that's really tricky. But nonetheless, it does grow without any taxes whatsoever. Really, really powerful. Matter of fact, it's the biggest thing I've seen as far as that goes. It's really, really important, and I advocate this wholeheartedly. Yeah.
So now that the U.S. is restricting some semiconductor sales to China, what is the market outlook for semiconductor stocks and ETFs? And would this be a good buying opportunity since they're kind of pushed down right now?
Yeah, we saw, NVIDIA drop 11% this week because of their announcement that the U.S. is restricting their ability to sell some of the high-end chips to China, artificial intelligence, those types of things. And so it's the beginning of a kind of a continuation of a trade war in a lot of ways. It wasn't, it was $400 million, which is a lot of money, but it's not that much money to NVIDIA. It was probably a little bit of an overreaction, in my opinion. And I know Kathy Wood with the ARK funds bought a lot of NVIDIA, for example, so she obviously saw some value there. I think one of the things I look at, though, in terms of, there's the basket of stocks you can buy, like the SOXX, the iShares Semiconductor ETF that we've had in our portfolios over the years in the past. Don't have it now per se, but the one thing I would be, it depends on timeline and what you're looking at. So semiconductors, in my opinion, are still they're on the higher end of the multiples in terms of the PE ratios across the group. You can find some cheap ones, but there's some really expensive ones. But if you look at the entire ETF, it's more expensive than the market is in general. And so one of the things that's happening because the primary trend right now is down, right? Primary trend is down. And when the primary trend is down, things that have higher multiples generally get crushed even more. And they try to bring those multiples down even further. And we've seen that this year. The semiconductors are down more than the market as a whole. There is opportunity, but you just have to have the right timeline as far as that goes. So if you're saying, hey, I think semiconductors will be worth more in 5 years, I would agree with that wholeheartedly. And yes, semiconductors are a lot cheaper than they were. So yeah, not a bad thing to do. Hey, I'm trying to make money in the next year or something like that. I don't know, right? And so I would consider, for example, one of the things that I do in my own portfolio is I have a percentage allocation to different things. So I have 4% allocated to semiconductors. And so when the market drops in that area more than the other things in my portfolio, all of a sudden I've got 3%. I'll buy more. I'll bring it back up to 4%. So that's my way of kind of dollar cost averaging back when it drops. Because again, I have at least a 5-year outlook on that, so I'm okay with that. And then if it goes to 5 or 6 or 7% of the portfolio, I let it run. And so that's my way. And I've got several categories that I do exactly like that: cloud computing, clean energy, you name it. And so I'm, just as those particular categories kind of drop, I buy more. Now, in that particular case, you got to have some conviction. You got to really, really feel good When I put something in the portfolio like that, this is more for something I do for myself, but I've got to say to myself, when that drops, I want to buy it. And so, Target, I had Target got hit pretty hard. When that dropped, I had no problem buying it. I really like Target. It's got relatively low multiples. I think what they're going through is temporary. They're a well-run company. They're really well positioned. Every time I go there, they're super busy. But it's still down for the year, because it dropped like 30% in 2 days after one of their earnings reports. But semiconductors would fit into that category for me in terms of, conviction. But in terms of, hey, how's it going to do here in the next 3 to 6 months? There could be a fair amount of pain because the overall market, it's kind of like the tide. When the tide goes up, it raises all boats. Well, the same thing happens when the tide goes down. And things that have higher multiples can sometimes come down faster than those other things. So I'd be a little careful, maybe dollar cost averaging in, or having something like I'm doing, a small percentage that you just keep buying if it does come down and let it run if it goes up. But that's a category I like overall, and I think it'll be higher in the next 5 years.
So how would you handle if, let's say I have $10,000 of cash and I want to get into semiconductors now? I believe it's a buying opportunity. I have a long time horizon, but I understand that the market is on a downtrend. So what would be a good strategy for, investing that $10,000?
Okay, so I'm going to assume $10,000 is some certain percentage of your overall portfolio that you have at this point in time, and so you're just going to try to fill that out. And so I would take some dollar cost averaging approach right now, $2,000 a month, $1,000 a month, something along those lines. So kind of that 5 to 10 month range, and put that money in, consistently during that period of time. And so that's going to be some percentage of my portfolio going forward. And then I just try to do what I just said, maintain that percentage. So now I'm up to 2% or 5% or whatever it is. I don't like to go real high in certain areas in my portfolios. I like to keep things diversified. But then I try to maintain that. So if I had other monies after that 10,000 and it dropped to 9,000, I'd try to bring it back up to 10, right? If it jumped up to 12, 15, okay, I'm going to let it run for a while, right? And if I see a lot of strength, sometimes I'll also buy that. Yeah, that's how I do it right now. Because if we were in a primary uptrend, that wouldn't be the case. I'd probably just put the 10,000 in there and just try to, if it drops, buy some more. But we're not in a primary uptrend. We're in a primary downtrend, and we are still there. I thought we might break out. I was really hopeful. Didn't happen. And so really at this point in time, that's where the dollar cost averaging I think would be great. Because if it does continue down, you continue to buy shares. If it goes up, straight up from here, you wish you would have bought all of it with 10,000, but that's okay. So something in that 5 to 10 month range would probably be pretty good. That's what I'd look at. Okay, good. We've got a great show today. Really good questions, actually. I had fun answering these. Send your questions in now for next week, and be aware that we can help you with a lot of these different areas. Sometimes there are things that we don't really cover that much, but throw it at us and let's see what we can do with it. And you can send that to Ask Tom at talkmoneywithtom.com. Of course, you can also subscribe to our channel. If you want to continue your process of education, hopefully if you're watching today, you've realized how much detail there is in a successful retirement and how much you can help yourself here. And so you can hit the subscribe button, hit the little bell if you want to get notified. And of course, book an appointment. If you'd like to talk to Ethan and I for 30 minutes of phone or video, you go to the website. There's a link right here on the channel to the website that we have. Up in the corner is a button, looks just like that. Hit that. You can go onto our calendar, find an open time, and set up an appointment to just do a phone or video with us. And, we look forward to that too. So anyway, like the show today, I'm glad that you can join us, and hopefully you can come and join us again next week. Thank you very much.